So we'll be doing the comprehensive problem in chapter 5. So first you put all your titles from the instructions it gives you. So cash, accounts receivable, supplies, equipment, accounts payable, unearned revenue, common stock, dividend, service revenue, salaries expense, supplies expense, utilities expense. You put them all into your general ledgers and put all your accounts in here and get ready. So the first step you do is you start off with your general journal. You put all the entries that it gives you. So for this one, August 1st, you would go put August 1st. And it says Cliff issued 70,000 shares of common stock for cash. So for cash, your cash would be your debit, your common stock would be your credit, and your debit and credit would be 70,000 and 70,000. So for the second one, it would be August 3rd. You go over here, you put August 3rd in your general journal. You skip a line so that way it won't be so complicated for you. It says Cliff purchases barbering equipment for 45,000. 37,500 was paid immediately with cash, and the remaining 7,500 was billed to Cliff with payment due in 30 days. So Cliff paid 37,500 in cash immediately. He owed 45,000, but now he owes 7,500 that he has to pay in 30 days. So you go to your general journal. Your equipment would be your debit, and your cash and accounts payable would be your credit. So it'd be 45,000 and 37,500, and then 7,500 on your credit. For the next one, August 6th, Cliff purchases supplies for 300 cash. So Cliff is losing cash. So your cash would be your credit. Your supplies would be your debit. You go over here to your general journal. You date it August 6th. Supplies your debit, cash your credit. Over here you put 300 and 300. And that's what you normally do in your general journal. Just back and forth, back and forth. Make sure you name it correctly and make sure you know what your credit and your debit is, if he's losing or if he's gaining. So then you would take all of these accounts from August 1st through August 28th and go add them to your general ledger. So for August 1st, I had cash for 70,000. So I would go over here to my general ledger and I would put August 1st from page 1, 70,000 debit. My balance would be 70,000. And I'll go back and I'll see I have common stock. So I would go look for common stock on my general ledger. And it's right here. You would put August 1st, page 1, 70,000 credit. My balance would be 70,000 credit. For the second one, August 3rd, so equipment, you would go look for your equipment. So equipment right here, August 3rd, page 1, 45,000, 45,000. That's what you would do as well. You just go back and forth, making sure all your amounts are correct, and yeah. So next up would be an unadjusted trial balance. So for an unadjusted trial balance, you get all of your numbers from your general ledger. So you get your all your numbers from your general journal and you just add them to your general ledger. And from there you see if it's credit or debit. And if it's a debit balance, you just subtract all the ones you get from credit, and when you get the debit ones, you just add them, and that'll give you your total. And so for the unadjusted trial balance, you label them from assets, revenue, and then your equities, and then your expenses. So I got cash, accounts receivable, supplies, equipment, accounts payable, unearned revenue, service revenue, common stock, dividends, salaries expense, supplies expense, utilities expense. And so you add them right here. You get them from your general ledger. So for cash, I got 35,275. For my accounts receivable, 2,500. For my equipment, 300. For my equipment, 45,000. For my supplies, 300. And then for my accounts payable, 5,500, unearned revenue 3,200, service revenue 9,200, common stock 70,000. My dividends 150, salary expense 4,600, supplies expense 0, and then utilities expense 75. And you just add all of these numbers up, get you a total, and these numbers have to add up to the same total. Now from here, we are going to go to the adjusting entries. So let's go. So for your adjusting entries, what you do is you get a new general journal page, and you can label it adjusting on top. And all of these will be at the end of the month for August 31st. So you will have new general journal entries that you would have to put. So for this one, Cliff took an inventory of supplies and discovered that 250 of the supplies remain unused at the end of the month. So if we go back, Cliff had bought $300 worth of supplies on August 6th. At the end of the month, he discovered that 250 is still new. So you just subtract the 250 from the 300. And then from here you go supplies expense and supplies. So August 31st, supplies expense, supplies. And you put 50. For the second one, the equipment purchased on August 3rd depreciated 2,500 during the month of August. So for this one, you go put August 31st. It would be a depreciation expense for equipment of 2,500, and then your second one would be accumulated depreciation of equipment of 2,500. And that's what you do on the adjusting general journals. You just go back and forth and label. Make sure that you're labeling them right in order to be correct on your general ledgers and adjusted trial balance. So now you take all of your general adjusting journals entries and put them on your general ledgers. And then from there, you just create another adjusted trial balance from when you get your general ledger done. So you will have new ones because of the adjusting general journals. You will have new accounts in here, and you will have a new total once you add them all up. After this, you create a financial statement form. You start with the income statement, which will be your revenues and your expenses. You get all your revenues, add them up. Get all your expenses, add them up. And then you subtract those two, and that gives you your net income. And then you go to your retained earnings, which from the beginning of the retained earnings, you start with 0. Then the income from the income sheet was 25. The dividends was 150. And at the end, the retained earnings were 125. And then you go, and then the final financial statement form is your balance sheet for August 31st. You get all your assets, your liabilities, and your stockholders' equity. You put all your assets, you add your assets. It'll give you this number. It'll give you a total. Then you go to your liabilities. From your accounts payable, income tax payable, and revenue, your liabilities will be 1,100. And then your stockholders' equity will have your common stock, the ending of the retained earnings. And once you get the total of this total, you add. So you get your common stock and your retained earnings, and you subtract the 125, and that'll give you your 69,875. And with the total of the stockholders' equity, you add your liabilities to that, and that total will give you 80,875. And your assets should equal your liabilities and stockholders' equity. So after you get all of those statements done, you will be doing a closing general journal. So all of your closings will be on August 31st at the end of the month. So you get your revenues and then the income summary. So you add your revenues and that will be your income summary. On the second one, you get all your expenses, add them all up. That'll give you the income summary. And then for the third entry, you get your income summary from subtracting the first income summary of the revenues from the expenses. You subtract those and it'll give you 25. And then you get your retained earnings from your retained earnings financial statement form. Make sure they cancel out. And then from August 31st, you get your retained earnings and your dividends. Make sure they cancel out. So all of your income summaries and your closing general journals will have to cancel out. And then from there, we are ready to prepare a closing trial balance. So all of the ones that were on your closing general journal will not be on this because they zeroed out. So they don't have a number. So there's no point in adding them. So you would just put the rest of the assets you have left and your revenues and whatever else, like your equities or your expenses. So you just get your totals again and then you add them up, make sure they equal each other at the end. And yeah, that's how you do it.